Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
Job numbers came out today and unemployment rate dropped to 4.2%. If you bank at Capital One, they'll be eliminating all consumer overdraft fees on checking accounts. But now for the bad news. Coffee prices are hitting 10-year highs. Oh, so it ain't, say it ain't so. We've got that and more tonight on Wall Street Wrap-Up. Hi, welcome to Wall Street Wrap-Up. I hope your week went well. I'm Andre Laborde. Our goal is bringing Wall Street to your street for today, for Friday, December the 3rd, 2021, and to get you ready for the week ahead. Well, this week in the stock market, it's a lot like riding a roller coaster. You know, the euphoria as the markets are going up, but oh, what a wild ride as it was heading downward. And this week, a new strand of COVID, now called Omicron, shook the market with a fear of another lockdown as last year. Then Fed Chairman Jay Powell took questions from Congress where interest rates may be moving higher than previously expected because of inflation. And then if those two things weren't enough, the jobs report came out today for November, and expectations were for an additional pickup of 573,000 jobs. But instead, a disappointing 210,000 jobs were added in November. You mix all these things together, and you get a panic on the street. Well, what timing? Because tonight, we'll be talking about the economy, about inflation, about rising interest rates. In just a minute, we're going to be talking with Thomas Hoenig. Now, Tom was the former president of the Federal Reserve Bank of Kansas City. He was also vice chairman of the FDIC, and now a distinguished fellow at George Mason University. And Tom's going to be with us in just a moment. But first, well, I briefed earlier, but just how did the markets do this week? All the major indexes were down for the week. The Dow Jones Industrial Average ended the week at 34,579. That was down 60 points for the day and down 0.9 of a point for the week. And the S&P 500, they closed today at 4,538. That was down 38 points for the day and down almost 3.5% for the week. And finally, the NASDAQ. They finished the week at 15,085, down 295 points for the day. Wow. And down 2.6% for the week. It was the Dow's fourth straight weekly loss. And now Dan Ives, for maybe some good news, Dan Ives from Wedbush Securities put Apple as a buy with a new price target at $200 a share. And Citigroup raised Burlington Stores from a neutral rating to a buy with a new price target for Burlington at $350 a share. By the way, Richard Hill, the analyst at Morgan Stanley, he raised Simon Group REIT, the real estate investment trust, to a buy with a new price target at $180 a share. Well, our guest this evening was the former president of the Federal Reserve Bank of Kansas City. He was also vice chairman of the FDIC, the Federal Deposit Insurance Corp. And Tom Hoenig is with us this evening. We've got a lot to talk about. Hi, Tom. Welcome to Wall Street Wrap-Up.
I'm very glad to be with you. Thank you for the invitation.
You know, Tom, I think it was Justice Potter Stewart who one time said when asked about pornography, he said, well, I can't describe it, but I know it when I see it. And I'll bet when you ask a lot of people on the street about inflation, well, they may not know about what the M2 money supply is, or quantitative easing, or even bond purchases. But just like Potter Stewart, I can't describe it, but I know it when I see it. You know, when it comes to inflation, do you think, are we in a temporary stage of inflation, or do you think this is going to be here for quite some time?
Well, I think the inflation genie is out of the bottle. And to your point, people do notice when they go to the grocery store, when they go fill up the gas tank, on and on it goes. So I think inflation's here for a while. And actually, I think there's important reasons for that. And I would start out by just telling you that inflation has really been with us for well over a decade in terms of asset inflation. We've seen home prices increase rapidly, almost double over the last decade or so. Commercial real estate, art, for example, stocks and bonds. So inflation's not due, and for some people, it's actually they've seen this in terms of winners and losers. If you held assets, you were a winner. If you're a wage earner, you were not such a winner. And the COVID experience, what I tell people, the COVID, what it did is it triggered and it intensified this inflation potential, and it accelerated it forward. And that's really what we're experiencing today.
You've got so much money being that, as you just brought up with because of COVID and other things, so much money has been and is being dumped into the economy right now. I know the Federal Reserve is now saying that they're going to be tapering bond purchases, going from $120 billion a month. I think they're presently saying that they're going to cut it by $10 billion per month. Well, that means that they won't even be finished until probably around summer of next year. Do you think that's the right speed, or do you think it should be accelerated?
Well, I think they're going to have to work themselves through it, and I think they want to start slowly because they don't know what the consequences are being. One thing they are very much concerned about is triggering a financial crisis on top of everything else. So they're going to go very carefully. But the fact of the matter is that the amount of money that's been put into the economy over the last 2 years, 20 and 21, has been phenomenal. I think the additional COVID-related expenditures, both direct and indirect through tax credits and so forth, is in the neighborhood of $6 trillion. That's in the hands of middle class, moderate income, and then the richer have received some of that, but also they've received some of the asset appreciation. So there's a lot of momentum, inflation momentum in the economy, and the Fed is beginning to, I think, slowly recognize that. And they contributed. If you think about it, most of the $6 trillion that was injected into the economy by the government in these programs was borrowed money, and the Fed accommodated that. The Fed's balance sheet, which in 2008 was less than $1 trillion, is now $8 trillion. So they have contributed to this, and so they know they have to back this out. And the question will be, can they do it in an orderly fashion, not cause financial crisis, not cause a recession, and also not delay so much that they worsen inflation. So they are really in an awkward situation. They're walking a tightrope, and I think it's going to be a very difficult road ahead, to be honest with you, because I don't think inflation is going to disappear. When you're doing that and also increasing the amount of money printed in the economy, you are risking greater inflation, and that's the consequence we're seeing today with the 6.2% inflation number that just came out recently.
Jay Powell has said that he did want a normal 2% inflationary rate. Well, I remember very well the days of Paul Volcker, who was the Fed chairman in the late 1970s, and he kind of had to break the back of inflation by raising interest rates so much that it decreased inflation there during that era and such. They're not even going to be starting to raise interest rates until possibly next summer. Do you think that is do you think that timeline is an accurate one?
Well, the answer to that is it's difficult to know, but I think there are really risks in waiting too long. For example, what you do by delaying is you make the ability to contain inflation as it builds more difficult. So if you go along the lines of waiting and seeing too long, and inflation becomes 7.5% or 8%, and then you try and slow it down, and then unemployment rises, so you delay, and then inflation becomes 8.5% or 9%, then you get to the Paul Volcker moment. And we want to avoid that. And I think the Fed wants to avoid that, but you can't do it by waiting too long or studying it too long, especially when you're this much above your target of 2%. And while logistics may bring it down temporarily to, say, 4.5%, whether it will stay there or whether this enormous, remember, we have a infrastructure bill that was just passed, $1 trillion there. We have a proposal on the table right now for a Build Back Better program that is marked at $2 trillion, probably much higher than that. There'll be a lot of pressure for the Fed to fund a lot of that to keep interest rates from rising from the injection of these dollars being spent by the government. So I think they're going to confront some pretty difficult challenges in trying to contain inflation. And that's going to delay it. And to the extent it delays it too long, then you get the possibilities of the type of need for a Volcker, shall we say, a Volcker moment ahead of us.
That leads right into my next question, of which you brought up about the over $1.2, $1.3 trillion infrastructure bill, plus now the next one that's going to be coming up. I think it was Milton Friedman who one time coined the phrase, "There's no such thing as a free lunch." And we're being told that if you're making under $400,000, all right, it's going to cost nothing. What are your thoughts?
Well, I think I'll just phrase it as wishful thinking, because it's not going to happen that way. We're already paying for it. 6% inflation, that's a tax. That's a very regressive tax on the middle class and moderate income families. And so we're already paying for some of that.
Milton Friedman always said inflation is a tax that Congress doesn't have to vote on. But just to emphasize what you're saying is that's what Friedman always used to say. Yeah. Mm-hmm.
Yeah, he said it, and he was correct. I mean, he was absolutely correct. And I think we're paying that tax now. I think that tax could get worse. They say that it's going to cost nothing, that someone's going to pay for it, but already it's pretty obvious that to make these numbers work, they had these sunset provisions in the law that everyone knows when the time comes they will be renewed, and that money will have to be borrowed, because I don't think your economy can grow if you're going to spend this money and then tax it all. That takes money out of the economy from the private sector, and I think has consequences as well to slow the economy. So there is no free lunch. That's correct.
I understand exactly what you're saying. I mean, the government does not produce. They have to take the money from the public to be able to reallocate it to spend it in other areas, and for doing that. Well, which also then leads me, Tom, to another thought of is that our national debt. Now, I know when right before going on with you and I checked it, and we were like at 29 trillion. By the time I finish this interview, it's going to be probably much now closer to 30 trillion because it's moving so fast. Do you think, are we at such a pace now, and now at trillion, that the thought of, you've heard the thought where our children and our grandchildren, well, now it's maybe our grandchildren and great-grandchildren will be, and great-great-grandchildren will be trying to pay off this debt. But it's not getting smaller, it's only getting larger. Are we past beyond the point of no return, you think?
We're never going to pay this debt off. That's the thing I think we have to recognize. The question is, how much of it are we going to allow to continue? Remember, in 2010, I think the national debt was $10 trillion. And then today, as you said, it's very close to $30 trillion. And I think if we continue that pace, if we're going to grow our debt faster than our national income, then I think we're going to be poor in the long run. So what we have to do is, I would not say you have to pay off the debt. It would be very harsh, take a long period of high taxes. But what we can do is begin to moderate our spending to where at least our debt levels are growing less than our national income, so that the private sector can carry us forward from here. And thus, over time, our national debt grow at a slower pace than our national income, and therefore the debt burden will be less over a generation. There is this assumption that the Fed will just print this money and we will take care of things and worry about it later, has to stop if we're going to have an economy that has a long-term, stable, wealth-producing economy for not just ourselves, but for the next generation and the generation after that.
When we were talking about interest rates, well, when the time comes that interest rates will have to be raised, I mean, right now we're at between 0 and 25 basis points, 0.25%, let's say, for every quarter of a percent of interest that the Federal Reserve raises, that adds X amount more. The that Treasury bonds have to pay, that we have to pay on the national debt. So this only accelerates our debt clock even faster.
Exactly. Look, you have to pay interest on this. It requires, and they say, well, we will be able to do that. Yeah, we can print the money and do it, but that means we're going to actually worsen the inflation outlook. So you can't win at that game. But I do think that we cannot afford to continue to add to this debt. And remember, it's not just that you're adding more to the interest payment, you're slowing the growth of the economy, which makes that burden even worse.
True. When the last numbers that came out from the Labor Department, Tom, is that we had a participation rate of something like 61.6%, I think, if I'm not mistaken, 61.6%. Right. Yeah, of participation. Well, I was talking to somebody this morning, and we were even discussing it. If it's 61.6% participation, that means there's about a 38.4% of non-participants. Well, unless you live in the basement with your parents, if you have to pay a mortgage, if you have to pay rent, if you go to the grocery store, you have to participate in earning money somehow. How do you not participate in the economy?
When they say 61.6, the normal rate prior to the pandemic was about 67%. So that's the number of people in the labor force. There are others, who are unable to work and so forth. But the thing is that's what appears to be a small reduction of a little more than 1 percentage point. That's actually a very large number, and explains why we have some of these labor shortages right now. Because the programs that were introduced during the pandemic to support people, and understandably so, but also encouraged them to wait longer to re-enter the workforce. Mm-hmm. And so some of those programs didn't end until the end of August. And we noticed that by October, that's when we had this big increase in the employment of 600,000 in the private sector. That was a reflection of the fact that these support programs have ended, and we finally have people re-entering the workforce. And I think as this continues, people in modest and lower income will be re-entering it. But we're still short. We've had a structural change in unemployment because the baby boom generation is retiring very quickly. They're not being replaced as quickly as they are retiring. So you have those structural matters, and then you have the cyclical matters in terms of the government supporting them. And so we have a very slow return into the labor force, which I think is causing wage increases. And from the labor point of view, that's a good thing. Unless we get the price inflation under control, labor inflation will probably follow for some time then.
True. If you're just joining us, we're talking with Tom Hoenig. So happy to have him. We're going to take a break, but don't go away because we'll be right back. Talking with Tom Hoenig. We're talking about the economy, about inflation, about the debt. I remember I was watching Ken Langone, who was a former co-founder of Home Depot, and he brought up a very interesting point. He goes, when an employer pays an employee a hourly wage of whatever $17, $18 an hour, $19 an hour to get them in, you can't then go back giving them then $16 or $15 or $14 an hour. So those labor wages have to stay in place. So do you foresee then something like this to be long-lasting?
I do. And remember, you're paying them to come into the labor force. They are receiving this, and then they see prices increasing. They're going to want more money, not less, because they want to keep their standard of living up. And so that's why I say you get this cycle of wage and price increases that I think only accelerate the overall inflationary problem in the economy. And so you have to get people confident that prices are going to stabilize. And therefore, if I get $16 or $17 an hour and I don't get a raise, that I'm still okay. I haven't lost ground. But if you get $16 or $17 and prices go up to where that $16, $17 didn't buy as much, then you are saying, I need more money. And if you don't, then you get labor unrest. We saw where the John Deere unions actually negotiated, if I read this article correctly, for wage inflation index wages now. So you're already getting them to think about, hey, I better hedge myself going forward. Now, that's where you have a union, but the market itself, people are they read this stuff, they're pretty astute, and so they're going to expect more as well as we go forward from here. People want to be paid, and they want to keep their standard of living up or improving. They don't want to see themselves fall behind.
You brought up a little bit earlier, touched on it, was supply disruption. You know, with right now we have so many supplies that are in the middle of the Pacific Ocean waiting to dock, either
Yes.
Los Angeles Harbor or Long Beach Harbor, and as well as other harbors as well too. What type of a dent do you think this will put maybe in the fourth quarter of the GDP, or maybe going into 2022?
We'll continue to have some shortages, as we keep hearing about. I think we'll see that effect on prices. As shortages occur, prices tend to go up. But those are logistic issues that will, I think, be addressed over time. They will eventually catch up. I think the more serious issue with supply is whether or not, as we've had this period of trade disruption in the sense of tariffs, regions of the world kind of self-containing, Europe and the UK, as I mentioned earlier, the China and the United States, Asia, India, as they become more isolated and less willing to engage in trade without tariffs, then you have shortages become structural longer term. And that means you'll have to change the structure of your own economy, or prices will continue to rise as shortages take place. So those are very significant issues that we confront when we talk about supply disruptions, and long-term effects. And remember, I've heard it for years that we're running too large of a trade deficit. Well, that may be true, but remember one thing: the only way you reduce a trade deficit is you have to produce more than you consume. Mm-hmm. And that's not something the U.S. is used to doing. We have been a major consuming economy.
We're used to consuming more than we're producing. Mm-hmm.
We consume more than we produce, and we have for a long time, and that's not an easy situation to change.
You've got so much experience being with the Federal Reserve. I'm curious, do you think at one time the Federal Reserve, even from its inception, was thought to be supposed to be non-political? Do you think that the Federal Reserve has gotten now maybe too political?
Well, I think to some degree the Federal Reserve has always been political in the sense that politicians want their people in those chairs, in those seats, and we saw it with Arthur Burns. We saw it to a degree with Alan Greenspan versus Volcker. That's always a part of it. They're going to have. That's not going to change. The real issue, I think, with that is when the chairman is put in that chair, whether or not he or she and the Federal Open Market Committee can act independently of the politics and be able to think long term in terms of their policy. And that, I think, is increasingly difficult because you have these very significant deficits. You want to be able to fund those and keep interest rates low. So there's a lot of pressure on the central bank of the United States, but also central banks across the globe, to print the necessary amount of money to accommodate the increase in spending without having to raise taxes. And that means borrowing it. And that means the central bank being the one who buys that debt, in a sense, and prints the money to provide that. That's where the real issue of, are these central banks becoming more and more subject to political influence in these trying times?
it's a conundrum because they want the interest rates to be low because one thing Congress loves to do is spend money. And if they spend money, but we're running a deficit, which means we're spending more than we're taking in. So that means that the interest rates have to be as low as possible so they can spend more money.
Right.
It's a
and that eventually leads to the inflationary problem that we're seeing today and could get worse. We saw it in the past. The thing about it is, like, again, it's back to our free lunch issue. There's no free lunches. And eventually printing this money, I think, will lead to continued asset inflation, almost for sure, and price inflation as well.
What a great way to end. Tom, I hope you come back. I've got a lot more questions, but the clock doesn't stop. Thank you so much.
You've been nice. You've been nice to invite me, and I've enjoyed every minute of it. Thank you.
Thanks so much, Tom. Appreciate it. Tom Hoenig. Well, if you've got a question about finance or a comment about the show, we'd love to hear from you. Make it pithy and concise. Write us at Andre@wallstreetwrapup.info. Keep it pithy. Like I said, we'd love to hear from you. Now, a look ahead for what's in store for next week. But first, according to Adobe Analytics, how much did consumers spend on Cyber Monday, this past Monday? Well, we'll have that answer in just a moment. Well, according to Adobe Analytics, how much did consumers spend on Cyber Monday? $10.7 billion. Actually, that's a decrease of 1.4% from last year, a year ago, and that was falling for the first time ever. Well, we've got some great guests coming up in the weeks ahead. In a few weeks, we'll be talking with Mario Gabelli. Now, Mario is the founder, the chairman, and the CEO of Gabelli Asset Management, and he's got over $40 billion of assets under management. Now, 2021, well, it's coming to an end, but how does he see 2022 shaping up, and where is he putting his money to invest so that we'll know where to put our money? In a few weeks, Mario Gabelli. Now, next week, we'll be talking with MasterCard Senior Advisor and former CEO of Saks Fifth Avenue, Steve Sadove. Now, Steve, I'm sure many of you are doing your Christmas shopping right now, or maybe not yet. Maybe you're waiting for Christmas Eve to start it. But whatever it may be, Steve Sadove will be telling us about inventories, retail, the future of brick and mortar, and just how will retail stores do this holiday season. Next week, Steve will be here. And as a reminder, we repeat the show on Sunday mornings, but the best way is to set your DVR so you'll never miss an episode. And, well, that's our show for Friday, December the 3rd, 2021. Hope you've enjoyed it. My thanks so much to Tom Hoenig for joining us this evening. But as always, we appreciate you for allowing us into your homes tonight. And remember, you can always follow us on all the social media, Facebook, YouTube, Twitter, and WYES.org. So, have a fun weekend and a productive week ahead. I'll see you next week for Wall Street Wrap-Up. I'm Andre Laborde. And remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.